Are you tired of seeing your trades turn into losses just when you think you've nailed the perfect entry? What if I told you there's a concept that could drastically improve your trade entries and exits, leading to higher profits and fewer losses? In this video, we're diving deep into the powerful concept of liquidity, especially from the perspective of smart money trading. But we're not just stopping at definitions. We're going to show you how to spot liquidity, grabs on your charts, and more importantly, how to leverage this knowledge to execute precision trades with jaw-dropping risk to reward ratios. So what exactly is liquidity? Let's start with a simple analogy. Imagine you're trying to exchange a huge amount of currency, say hundreds of millions of dollars. If you do this, when the market is quiet, prices will shoot up and you'll end up paying more. Big players in the market, like large corporations, avoid this by trading when there's plenty of liquidity, meaning lots of buyers and sellers so they can buy or sell without moving the market too much. This liquidity is the lifeblood of the market, and understanding where it pools can make or break your trades. So where are these liquidity zones and why do they matter to you? Liquidity zones are where retail traders, like most of us, are heavily involved in the market. These are areas where you'll see a lot of buying or selling pressure, usually around key levels like demand zones or trend lines. But here's the catch. These zones are also where big players or smart money come in to grab liquidity before making their real moves. For instance, when the price approaches a demand zone, traders start buying, thinking it's a safe bet. But where do they place their stop losses? Below that demand zone. Smart money knows this and will push the price down just enough to trigger those stops, grab that liquidity, and then shoot the price up, leaving retail traders in the dust. Why should you care about identifying liquidity zones on your charts? First, spotting a liquidity zone before demand or supply area can set you up for a perfect trade. These zones act like fuel for price movements. Without them, the market might stall. Secondly, by identifying these zones, you can avoid placing trades in areas where the odds aren't in your favor, reducing your chances of getting stopped out by sudden market moves. Let me give you a concrete example. Imagine the price breaks through a key level, leaving an order block, a sort of footprint of smart money's involvement. If the price comes back to that area, it's like a magnet for liquidity, creating a prime opportunity for a well-timed entry. But remember, this isn't foolproof. Always look for confirmation on lower time frames before pulling the trigger. Types of liquidity on the chart. Liquidity zones can take many forms: trend lines, consolidation areas, even major moving averages. But if you want to keep things simple, focus on equal highs and lows. These are the areas that most traders will focus on, making them perfect targets for liquidity grabs. Let's walk through an example. Say you spot a nice upward move, but with some inefficiency, perhaps a gap that hasn't been filled. You know, smart money likes to close these gaps, so you wait for the price to come back down, fill the gap, and then make your move. At the same time, be mindful of major support and resistance levels. These act like magnets for liquidity and can set up perfect trading opportunities. Now that we've covered the basics, let's talk about our key liquidity trading strategy. Before diving in, if you're enjoying this breakdown and finding it useful, make sure to give the video a thumbs up and hit that subscribe button. It really helps us out and keeps the content coming your way. Our strategy isn't tied to any specific time frame. You can use it in Forex, crypto, or stock markets. It's straightforward, consisting of two key steps: identifying the trend. We use an exponential moving average, EMA, to do this. Apply the 50 EMA to your chart and look for a break in one direction. Once you see this, wait for the market to make 3 moves in that direction, breaking the previous market structure. This tells us that the trend is established, and as long as we stay above the higher low, we're looking for buying opportunities. Looking for a liquidity sweep. Here's where it gets interesting. After the trend is established, wait for the market to create a support level, then either wick below it or close below it and come back above. This liquidity grab is your signal to enter. You can either jump in right after the liquidity is grabbed or wait for a confirmation candle. Your stop loss goes below the liquidity grab and your target is the next level of market structure. Here's a pro tip. Always check the higher time frames to see where the price has room to move. If there's space to the next level of structure, you've got a good trade setup. If not, be cautious. It might be better to sit on the sidelines. And remember, this strategy works both ways. Whether you're trading a bullish or bearish market, the principles remain the same. Let's take a quick look at a bearish example. On a 15-minute chart, you see the price breaks below the 50 EMA with 3 moves, confirming a bearish trend. The market then creates a resistance level, breaks it to grab liquidity, and quickly returns below that level. This failed breakout is your cue to go short. As I mentioned earlier, this strategy isn't confined to any particular time frame or trading session, so be sure to backtest it across different pairs and time frames to see where it performs best for you. With that said, thanks for watching, and until next time.